All right, I am the type of person that starts on time. Honor to people that get here on time. So tonight is Amazing Financing Strategies for Real Estate Investors. I'm James Orr, and here are the upcoming classes. So next Tuesday, my son is in a band, and he's performing live for the second time ever. And so there's supposed to be a class on Young Professional Nomad. I am going to be allowing people to watch the recording of the last time I taught that class live. So we will make that available to everybody on the website. So there will be a recording on Tuesday, probably from 6 to 8. I might put it up earlier in the day and leave it up for a little while longer, but you can go watch that and have it available. And then next Wednesday, a week from tonight, we're doing buying process overview. So you'll see some slides tonight where we've got some of the parts of the buying process where we go over financing, but we're going to go over the entire process for buying next week on October 18th. Then one of my favorite classes of all time, how to acquire a multi-million-dollar real estate portfolio starting with just $3,000. And so you can actually do it with less. You'll see tonight when we go over financing, you can do it with nothing down. However, $3,000 makes it a little bit more achievable because the loans are a little bit easier to do and it allows you to have bigger areas and stuff. So that's going to be a webinar on Tuesday night, October 24th. And then 2 weeks from tonight, there's going to be Finding Amazing Real Estate Investor Deals. It's going to be all about how to find deals. That's going to be on October 25th. What are you laughing about already? What? Oh, okay. Like you're passing gas or something? No. Okay. So Finding Amazing Real Estate Investor Deals, that's going to be Wednesday, October 25th. So we'll go ahead and do that. And then Analyzing Deals, Cash-on-Cash Return on Investment, and that's going to be on November 1st. You'll notice there is not a class on Halloween. We do webinars from my house. And I happen to live in one of those neighborhoods where everybody brings their kids. And I'm not going to be doing a class where my doorbell's ringing like every 2 seconds because 500 kids come to my house for Halloween. And just kind of like teach it as I hand out candy and stuff like that.
Hi to everybody on the web.
Yeah. Although, yeah, I have... there's something about Halloween that doesn't make sense to me. You know, all year long we teach our kids stranger danger and, you know, don't eat anything from someone you don't know. But one night a year, all of you little kids can go around to not just one stranger's house, but let's go to 100 different strangers' house. Let's stick random candy in a bag, shake it up, and then let's see which one's poisoned or kind of razor bladed or needled. That's the night everything's okay to do. I don't know. That's just, it doesn't make any sense to me at all that this is the one night we can do it. So either it's there's no stranger danger at all, or we should not do it on this one night. We should do it every night. That's the thing. Yeah. Okay.
Send your kids out about March 1st to trick or treat, and that'll go good. Yeah.
Let's see how well it goes over. Trick or treat, and someone comes out with like a can of Spam or something like that. That's all people want to give away. All right, so anyway, so Analyzing Deals, Cash-on-Cash Return, that's going to be on November 1st. Anyone have questions on the upcoming classes? Is that your class or my class? I'm just curious. I'm hoping it's yours. I honestly thought tonight was you. Tonight? You look at the presentation, you tell me if it's yours or mine. I think it's yours. I added some stuff. I added some stuff, but I'm pretty sure it's your presentation. Plagiarist? I don't know. They kind of get merged together. So, I don't know. It's sort of how to analyze a deal, except I think it's mine because I took a whole bunch of pictures of your spreadsheet and I talk about the sections. Yeah, it's good stuff. All right, so those are upcoming classes. I think tonight that was you. So anyway, let's go around the room. Who are you and what is your biggest financing concern? And then a little note, please do not take photos of slides or record audio or video of NCREG presentations. And before we do introductions, is there anyone who's new and has not gotten a copy of the newsletter? You guys haven't. Anyone else? Okay, cool. And then people that are new, if you filled out the form, we only have a single copy left of this book. So if you haven't filled out the form, let me borrow this from you. If you haven't filled out this form, we only have one copy. So yeah, first one in to Allison wins. That's the last one we got. Yeah. And then finally, I have handouts for everybody, which I'll give out at the point in time for that presentation. And finally, clients who have not gotten the 2018 version of this book, come see me after class and I'll give you a copy of that. All right, those are my announcements. Oh, one other announcement. And that is clients, I also have a new service I offer, which is being able to pull rent comps. I subscribe to a service so we can pull up rental comps for any property. So let me know if you need that, and I will do that for clients as an extra service. All right, let's do introductions. Elijah, you get the pole position here. So who are you and what's your biggest financing concern?
My name's Elijah. Probably the biggest concern at the time is just getting over some past credit issues.
Okay, awesome. Thank you. Welcome. Hello.
Hi.
We're together.
Okay.
So we're partners in our real estate investment business, I guess.
Okay, cool. What's your biggest financing concern?
So we own a few. Oh, I'm Kurt, by the way.
Oh,
This
awesome.
is Kathy.
Hello.
My wife, Kathy. We own a few investment properties.
Okay.
And we've got all but one of them financed, and so we're trying to figure out how to pull capital out of those and be able to reinvest some of that.
Okay, cool.
And continue to grow, you know.
All right, awesome. We'll talk a little bit about refi. I think there's a slide on it. So thank you. Welcome. Hello.
Hello, my name's Nick. Same thing, kind of learning about refinancing some existing properties and
Okay.
overall knowledge.
Awesome. Did you lose a name tag?
Oh, I took my code off.
Oh, okay. I was just like, what's going on here? Hello.
I'm Brandon. Biggest financing concern is probably just continuing to find down payment money as the portfolio grows.
Okay. Awesome. Thank you. Welcome. Allison, who are you? What's your biggest financing concern?
Hi, I'm Allison, and I guess my biggest financing concern would be being able to get the down payment in the first place.
Awesome. Thank you. Welcome. Hello.
Hi, my name's Eric. My biggest concern is getting down payment money to purchase the next home and possibly refining the current property, pull equity out, and how that all kind of works.
Awesome. Thank you. Welcome.
My name's Rob. I'm kind of just getting started, so I'd say my biggest financing concern is probably just overall ignorance of the process and all the unknowns. So.
Awesome. Thank you. Welcome. Hello.
My name's Alex, and I'm also pretty green at this, so I just kind of want to learn the ropes of what my better options would be for different situations and scenarios, especially with financing. So.
Awesome. Thank you. Welcome. Hello.
Hi, my name's Julie. I guess my biggest concern would be I want the least amount of cash out.
Minimal down payment, you mean?
Yeah.
Okay.
I want to hold on to as much of my cash as I possibly can.
All right, cool. Awesome. Thanks. Welcome.
So I'm Tom. Kind of similar story here. I've got several properties that I'm interested in pulling cash out of to use for other things, but I'm also interested in figuring out how to go about and mastering how to go about financing fix and flips.
Okay, cool. Awesome. Thanks. Welcome.
I'm Zach. Biggest financing concern, probably one, continually having that down payment money that you need, and then also being able to finance multiple deals at one time and how to be able to structure those correctly so they don't undermine each other.
Okay, awesome. Thanks. Welcome.
I'm Beth. I'm with Zach. So similar concerns and just not having so much of our own money in both the rehab costs and the down payment.
Awesome. So partnerships? You want partnerships so that you don't have to do the down payment yourself, you mean? Yeah. Okay, so you need a money partner. Yeah. Awesome. Thank you. Welcome. Hello.
I'm Brian Williams. Long-term buy and hold investor here in Northern Colorado. My biggest financing concern, I'm not sure I have any at this point, but it's always just getting the next loan, right? Doesn't matter how many properties you own. It's like at some point one bank will say no, but there's always private money. So I haven't had a lot of concerns financing.
Awesome. We buying a bunch of duplexes?
I don't think so.
Okay.
We talked about it.
Okay. All right.
Interesting.
Interesting conversation or interesting we're not doing it?
No, it's an interesting possibility.
Okay. We'll talk more about it
I
tonight.
want to know where you're finding them.
Well, they don't exist. They exist in real.
Oh, there's an idea.
Awesome. Hello.
I'm Scott. My biggest financing concern is just stretching the money I have to as many properties as possible and still being able to not have to shell out money every month.
Sure. Yeah. Awesome. Welcome.
I'm Daphne, and same with you, refinancing, especially in the neighborhood we have.
Awesome. Thank you. Welcome.
I'm Shauna, and my biggest financing concern would be making sure my money gets to closing. Like the lender, not me.
Okay, like the lender shows up with the loan? Yeah, that's actually a concern. As a side note, in our real estate contract, if your lender doesn't show up with the money, it is your fault as the buyer. So it is not the lender is not a party to the contract. So you are in default if your lender doesn't show up, as a side note. Thank you. Welcome. Tammy.
Tammy, there's nothing super pressing right now, but I guess just more long-term logistics of, especially with ARM loans, what happens to interest rates, what the best strategy is to do with those particular loans.
Awesome. Thank you. Hello.
I'm Steph, and mine is mostly just what's realistic for down payment, having realistic, monthly payments, as well as for converting that into a rental and having an operating account within, or what's necessary. So basically, just what's realistic, what kind of money do you need to be successful?
Okay, awesome. We're going to cover a lot on down payments and what the monthly payment is for that tonight. We don't cover how much cash reserves you have, but there's a big debate in this room as to actually how much you should have. My general rule of thumb is 6 months principal, interest, tax, insurance, HOA. So that's what I think you should have per property. And the argument is, as you get more properties, you probably don't need 6 months for each one. But
However, there's an argument to be made by some older, and maybe wiser, unsure investors that 2 years is a good rule of thumb, right?
that could arguably a good rule too.
Imagine you're going through the downturn, and if you got 2 years, you can make it through pretty easy,
I would agree with that.
right? 6 months, maybe, maybe not.
I would agree. Yeah. Awesome. Thank you. Welcome. Hello.
Hi, my name is Scott, and I'm pretty much with her on that. Is just figuring out logistics of what's real and what's not for down payment, as well as kind of operating costs of that and rolling into next year's helping with property perform.
Okay, awesome. Are you guys doing like a buy one, rent it out, lease option, the next one? Did you read the Nomad book? Not this one, the other one.
In the process of it.
Yeah.
Okay, good. You're reading it online? Or you got a physical copy?
Physical copy.
Okay, good. Awesome. Cool. Thanks. Hello.
Howdy, I'm Chris, and I think probably just long-term, I need more and more loans.
Okay. Awesome. Thanks. Welcome. Hello.
Brian, I think my big concern is just making sure I have all my ducks in a row to react to unexpected deals, be able to move on things. And then I also have a little concern and always wondering, will we ever see interest rates climb back up in any substantial amount like they have?
Yeah, I do a whole class on interest rates, like a 2-hour class. We're not going into interest rates tonight, but there's some really interesting stuff. If you only look back a certain number of years, it looks one way. If you look back over a very long period of time, it looks a completely different way. So that's worth watching if you haven't been to that one. We'll probably do it soon. So awesome. Hello.
I'm Curtis. I guess a concern of mine is having access to enough financing for surprises like CapEx, expenses, lawsuits, random things.
Okay, awesome. Thanks. Welcome. Denise, you just snuck in time. You're the last one. It's who are you and what's your biggest financing concern?
I'm Denise, financing concern?
You have no financing concerns. You're good to go? Awesome. Well, I am James Orr, and we're doing amazing financing strategies for real estate investors tonight. So you remember I told you that we were going to go over at some point, I think it's next week's class, the whole buying process overview. This is a visual of the buying process overview for working with a real estate agent to buy a house. The ones in blue are the ones we're going to be covering tonight that touch on financing. The one in green is the one we're going to cover next. So when you kind of see me transition between slides, I'm trying to show you big picture where you are in the process. So we're going to start off first with the first meeting with your real estate agent, and specifically we're going to cover the steps on financing and writing offers. Those are the two ones that are related to financing. The other things you discuss, for those that want to know, the two different documents, definition of working relationship, exclusive right to buy. Those are two documents you discuss. Receiving property lists, analyzing deals, looking at deals and preliminary due diligence, the contract to close, verifying assumptions, complete due diligence to closing, and then after the closings type of stuff. But tonight we're only covering writing offers and financing, and now we're going to talk about financing to start. So that's kind of big picture where we are in the process. So before we kind of get into this, I want to point out that types of financing changes over time. And that the loans we talk about tonight, they may not be here next month. They may not be here 6 months from now. They may not be here a year from now. There were loans we could get at one time, a couple in particular that come to mind. There used to be a nothing down CHFA loan, which is no longer available. And there used to be a $100 down HUD loan. Actually, Housing and Urban Development had a thing where you could buy HUD properties with $100 down. So over time, these loans come and go and they change. But the ones I'm going to cover tonight, as of the 9th of October, like 2 days ago, they existed. But if you go call your lender a month from now or 2 months from now or 3 months from now and you say, James told me there was a $1,000 down loan program, they may say it's no longer available. So just realize that up front. So check with your lender to get the most up-to-date information.
And different lenders have access to different loan programs.
Yep.
So the first lender you call may not be able to do a loan, but another lender.
Yeah, I have a slide on that too. So yeah, we're going to cover a little bit of that later. So before we start talking about the loan stuff, I want to talk a little bit about lender selection, because I think a lot of people in here assume it's let's call around to 3 different lenders and find out the one that has the lowest origination fees for the same rate. And that's what you're primarily searching for. So let me tell you a couple stories from working with a ton of buyers and kind of helping people buy and doing a ton of loans myself. So your lender, in my opinion, I think you should look at price, and price should be a major concern, maybe not the primary one, but there's other factors that go into selecting your lender. And I like to consider my lender part of my dream team, where they're going to help me strategize and figure out what loans I'm doing, what loans I'm going to have coming up, and how that's going to impact my whole financial situation. If you're going to somebody who is just the cheapest, they may not be thinking about step 2, 3, 4, and 5, and you may end up getting a great rate and saving $1,000, but screwing yourself on loans 2, 3, 4, and 5. Okay? So be super careful about that. So Dream Team, understand and works with your goals. Now the other thing about lenders is certain lenders have what's called overlays. So imagine you've got a pool of lenders, 100 different lenders over 100 different companies, and there's a big entity above them that is actually buying their loans. Okay? So you have 100 different lenders and 100 different companies. They may say the criteria for me to sell my loan to this big entity, because the lenders are basically originating loans and then they're selling them to this big entity. They may say you need to have a 720 credit score and it needs to be 80% loan to value. But the lender themselves may say, well, the minimum criteria for me to sell it to this big entity up here is 720 credit score and 80% loan to value. However, our company requires 730 credit score and 75% loan to value. So the companies themselves, all the different lenders, can add additional, more strict criteria than what the actual big company that's buying the loans puts into place. And what we call those additional stricter criteria is overlays. So if you ever hear a lender saying, our overlay is blank, it may not mean that the actual Fannie Mae or Freddie Mac, or whoever it is that's buying the loan from them, has that criteria, but their company might. So you go to a different lender, they may have different criteria for that. Does that make sense, everybody? Okay, so that is another factor. The other one is personality. There's a couple lenders whose personalities I just don't get. And so when you call them on the phone, it's really hard to talk to them. They're like either really abrupt and they want to get off the phone, and they're like, it's like you bothered them by calling them and trying to ask questions. That's a factor for me. Maybe it's not for you. Maybe you say, hey, if I'm going to save $500, I'm willing to deal with that crap, but it can come into play. Accessibility and communication. This is actually a really big one, because if you have questions about your loan, if you need to contact your lender in order to get a lender letter at night and you can't get a hold of them, or you've been calling them for 3 days and you're coming up on closing, you need to know how much to get your certified check for, that's a problem if they're not calling you back and not communicating. We've had lenders that have essentially disappeared. Right, Tam?
Occasionally.
Yeah.
It's not a lender we recommend. It's like somebody came with their own lender.
Yeah, and then all of a sudden we're trying to get a hold of them for like weeks during a process when you're under contract, and they're like dark. Their voicemail, it says, so-and-so's voicemail is not set up, or so-and-so's voicemail is full, and so you can't leave a message. You drop them an email, there's no response, like a black hole. That's a problem. Because whose fault is it if your lender doesn't show up with the money for closing? It's all of yours. The lender is not a party to the contract. You are in default if you don't show up for closing with money. Okay? So it's really important that they show up there. I'm going to talk about a seller concession example about communication. So I had a client go under contract on a property, and this lender was not very communicative, didn't really have good communication skills. And we asked them in an email in writing. It's one of the things we do for our clients. We ask the lender, are we using 100% of the seller concessions? Because what happens if you don't use seller concessions? If you negotiate in the contract and you say, seller, I want you to pay $5,000 toward my closing costs, and you only come in and you only use $4,000 of your closing costs, what happens to that $1,000 difference in our contract? Where does it go? Who gets it? The seller gets it. So the buyer doesn't get that money back, even though you negotiated for it. In some cases, it was a $300,000 property. You made an offer for $305,000 because you wanted $5,000 in seller concessions to use for your closing costs. But if you don't use that full $5,000, you basically overpaid for the property. Okay? So in this case, we email our lender and we say, hey, listen, are we using this full amount of money? If not, let us know so we can make an amendment to the contract, or we can try to figure out something to do with insurance, or figure out a way to spend the money so that we don't lose it. Okay? This lender said, oh, yeah, we're totally good. The day of closing comes, though, or I think the day before closing is when we realized it. And sure enough, they did not use all the seller concessions. And so we were all worked up over this. And I asked the client, Mr. Client, what would you like us to do? Do you want us to really push hard and kind of start a pissing match, or what's the deal? And I think the client was just like, I guess there's nothing really we can do on it, but it's kind of a bummer when you negotiate a certain amount of seller concessions and you end up not using it. And we asked in writing to the lender, are we good to use this? And we asked them like a week or two ahead of time to check this. So it's a real problem if they're not communicating with you and if they're not accessible. And I think that was part of what the issue was with that one. Here's another thing. A lender that's willing to go above and beyond, and when Brian teaches this version of his class, which I'm pretty sure this is his class, going above and beyond is a big thing he talks about. And he talks about it in the context of, if a lender asks you for stuff, you should be within like 5 minutes. Here's everything you ever needed. Here's all my tax returns, here's all my property stuff and everything else, and gives it to them so that when they have to go to bat for you, if they're going in front of an approval committee or something like that, and they need to make a judgment call, they're on your side. They're like, he's on top of stuff, he's all over this, he's good to go. Okay? I look at it in a slightly different way, and I'll give you an example. So we had a client of ours actually go and try to buy a property. Turned out the property was scheduled to close, I don't know, right before the holidays, Thanksgiving or Christmas. I think it was last year. And the lender submitted the first appraisal to underwriting. Underwriting reviewed the appraisal and said, we're not comfortable with what this appraiser did. We need a second appraisal done. Okay? So now Tammy and I are going and we're negotiating with the seller's agent, explaining to him, listen, we need more time. It's not our fault. The lender is saying, we need a second appraisal because there's not a lot of comps for this particular property. We need to go out there and do it. And the buyer was not allowed to pay for the second appraisal. Okay? So who's paying for it? I don't think the seller is. They had multiple offers. They had people in backup position. So who's paying for this appraisal? So it turns out that this particular lender is like, listen, I want to get the deal done. I want this client. I want to keep him as a long-term client. I am going to come out of pocket and pay for it. And so this second appraisal cost $2,000 because we had to do a rush fee because the seller did not want to delay. And it was right around the holidays, and it was like it's either Thanksgiving or Christmas weekend, wasn't it?
Yeah, it was near Christmas.
And so this is the weird thing where the appraiser picks it up and says, okay, it'll be ready in 2 weeks or 3 weeks or something ridiculous. And so I call the appraiser and I'm like, hey, listen, we're in a bad situation. The seller, this is the second appraisal we're doing on this. We're like, a week out from closing. We need to have this done. Can we pay you a rush fee or something like that to get it done? They're like, yes, I will go ahead and run out there this weekend and do it for $2,000. This is the second appraiser. Now, if you went and you got the absolute bottom of the line, cheapest lender you could possibly find, do you think that they're going to come out of pocket $2,000? I don't think so. So that's just something there. All right, so that's lender selection. Yeah.
The one thing you didn't talk about on that slide is performance.
Yeah.
You need a lender that can perform. Like, I would much rather take a known entity lender that has performed time and time and time and time again and pay a little bit more than take somebody who's like, I'm unknown, right?
$250 cheaper, but I've never closed a loan before in your state.
Right.
Yeah.
Yeah, and that actually matters. There's some serious state stuff that if your lender, there's a bunch of small banks all over the U.S. that are looking for loans, and when it comes down to it, Colorado is a table funding state, which means they fund at the table. Other states are not. And so if you have a lender that's coming from out of state that's never really closed a loan in the table funding state, stuff like that throws closings off for 3 days or a week or more. I've had that happen with someone buying a property with an out-of-state lender. So performance matters.
Yeah. Yeah, it's a good call. All right, so one of the things we're going to talk about tonight is private mortgage insurance. And so I figured I would just cover it up front early, tell you what it is, what kind of the criteria is and how it works. So what is private mortgage insurance? You guys ever heard of this? PMI, private mortgage insurance? Anyone know what it is? Class. Anyone know what it is?
Yeah, it's an insurance product you buy through the lender, and what it does is it guarantees the balance of what you're not making on a down payment for a conventional loan. So essentially, if you're putting 90%, if you're putting 10% down, lenders want 20% down. That's the standard in the industry. You buy insurance that basically covers that extra 10% should you default.
Yep, that's exactly right. So basically, the lender is requiring you to purchase insurance for them in case you don't perform. They're saying, hey, listen, I'll loan you the money. In fact, I'll loan you higher than 80%. However, what I want you to do is I want you to pay this third party money, and if for some reason you default on the loan, this third party is going to make good on the amount that you didn't put down. Okay? They're going to actually make up for that. And so the third party is the insurance company, and you as buyers are paying an insurance policy for the lender in order to do the loan. Okay? So that's what it is. It can be paid up front. You could say to your lender, Mr. Lender, Mrs. Lender, I actually don't want to do a monthly PMI. I would actually like to do one big chunk of PMI up front. You can also say to lender, I don't want to do any up front. I only want to do monthly. And in some cases, for some loans like FHA, there is an upfront PMI payment and a monthly component. Okay? How much is it? What factors goes in the amount? So the amounts I'm going to show you, I've got a handout for you tonight. I'm going to provide this to you, and you'll see some different PMI numbers, but it varies. So it's hard for me to tell you PMI is always $100 per 100,000 you borrow, or whatever it is. I can't give you that number. Why? Because it matters, number one, the loan type. The different loans you do have different PMI factors. The loan to value, you're going to pay a higher PMI if you're borrowing 100% of a property value versus you're borrowing 85%. And your credit score, which is one of the reasons why Brian takes such a big deal out of improve your credit score all the time. Even if you're at 760, moving from 760 to 780 sometimes will make a difference in your PMI payment. Okay? So you really want to make sure that you're looking at all three of these. When do you typically need to pay it? Less than 20% down. And there are some exceptions. VA loans are one example where you do not have PMI. Can you increase the interest rate and pay it up front? So some lenders will say to you, if you want to, instead of actually paying a PMI payment for the next 3 or 4 or 5 or 6 years, however long it takes for you to get to 80% loan to value, to build up 20% equity, instead of doing that, you can actually say, I will take a higher interest rate for the term of the loan, but I will not have a monthly PMI. If you understand it this way, so if you have a 4% interest rate and you pay money, you can buy down the interest rate. You can pay the lender to get a lower interest rate. But it works in reverse. You can actually say to the lender, instead of me paying you to take a lower interest rate, how about you pay me some money and I'll voluntarily take a higher interest rate? Okay? And that's what they're doing in this case. They're basically saying, let's go ahead and raise the rate and I will give you a credit and we'll use that credit to make an upfront one-time PMI payment instead of doing it monthly. Okay? All right, any questions on PMI? That make sense to everybody? All right. So types of financing. So now we're going to go through some different loan products and how they work. I'm going to first cover the 2 nothing down loan programs that exist in today's market. Okay? Number 1 is VA. Number 2 is USDA. VA, if you like to think about it, is a certain type of person. You need to have a personal qualification in order to get VA loans. There are some restrictions on the houses you can do. They have to pass health and safety, and they need to be under a certain price range. Otherwise, you need to pay more than nothing down. But otherwise, it is a personal qualification type thing. It's usually for veterans. Thank you for your service. Okay? Now, the USDA, it's not quite specific to a group of people as it is a group of properties. And it's for rural properties, properties that are not located in big cities. So Fort Collins does not qualify. However, Windsor qualifies. Loveland does not qualify. Parts of Greeley do qualify. Wellington qualifies. Cities like Berthoud and stuff like that, they are also USDA approved. Now, sometimes you'll have a property that's on the edge. You're going to say to me, James, this property's got a Berthoud address, but it's really in Johnstown, or it's really in Loveland, but it's on the border, and does it qualify or not? The ultimate say is the USDA has an eligibility website. You type in the address, it will tell you it is approved or not approved. And so if you've got a property and you're thinking about doing USDA, go check the USDA eligibility website to see if it is approved. Okay? All right, I'm going to run through these bullet points. So in order to do VA, by the way, this is Nomad approved. For nomads in here that want to buy a house, live in there as an owner-occupant for a year, then convert it to a rental, and then kind of repeat the process, acquire as many rentals as you want, this is a good loan to do, VA. Okay? So is USDA. But for VA, you must have VA benefits. It is 100% financing, and you can finance in your upfront fee, the funding fee, in order to do it. So it's actually over 100%. It is a fixed rate 30-year loan or a fixed rate 15-year loan if you want to do that. There is no PMI for VA. It's one of the few loans that does not have PMI. Okay? Instead of having PMI, the government is guaranteeing the loan. And that upfront funding fee that you pay is what the government is using as insurance. You must own or occupy it. You could do 1 to 4 units, so you can go buy a single-family home, duplex, triplex, or fourplex as long as you move into one of the units. You have to own or occupy it. You can have multiple loans possible, so I could go get a VA loan on a $100,000 property, then I can go buy a second one on another $100,000 property and still do both those with nothing down. You can do it more than once. The limit is what your VA benefit is. You cannot go over your VA benefits with multiple loans, and there's an exception to that where you can make up the difference pro rata. But talk to your lender about that. It's often longer and stricter appraisal, so it takes longer to have the appraisal done, and it's a little bit stricter appraisal. They have some health and safety stuff. You can do up to 4% of it from the seller to contribute towards your closing costs, seller concessions. If you want to go look at where the eligibility is, if you say, I was only in the military for 6 months or whatever it was, you can go see what the actual eligibility is right on the VA website, va.gov, that's the address. I'm going to tell you about funding fees on the next page, so we'll hold off on that. But let's talk about USDA. So USDA, again, is the rural property loan for things like Berthoud and parts of Windsor. It's for rural properties, 100% financing. It is also a fixed rate loan for 30 years. You must own or occupy it. There are income restrictions. You can't make too much money. Otherwise, they'll say you don't qualify. I think there may even be minimum income restrictions as well. Use the USDA mapping tool to verify, and many agents don't correctly identify properties in the MLS. This is actually true of both these. So if you go to another agent besides me and you say to them, hey, Mr. and Mrs. Agent, I would like you to send me a list of all the USDA properties in the MLS. When an agent enters the property into the MLS, they have an option of choosing which types of financing are acceptable. And they may select off USDA. The challenge is there are a lot of agents that don't even know what USDA is. And so they're like, financing, sure, we'll accept all these. Conventional, private financing, seller financing, lease option, USDA, VA. They'll just check them all off and say, sure, yeah, come with all your loans. But they haven't gone and checked to see if the property is actually in a USDA approved area. So you can't go do that. And then a lot of people, they just say, well, my seller really only wants conventional financing or cash. So we're not even going to list USDA. But it might be eligible, and you might be able to go to say to them, hey, listen, you haven't had an offer for 2 weeks. How about we do USDA? And they're like, all right, we haven't had an offer. We'll accept USDA. Okay? So you can't go and just say, show me the ones that are marked as USDA or VA. Same idea. What you really need to do is pull up the property, see if it's in the USDA approved area, and double check it on the USDA website. Okay? And then on USDA, you can do up to 6% seller concessions. Any questions on the nothing down loan programs? Are you guys surprised to hear that there are still nothing down loan programs available right now? Because most of the time people are like, I didn't even know that there were nothing down loan programs you could still do. Yep, 2 of them, alive and well, right here in Northern Colorado. Any questions? All right, so here is the VA funding fees of how much it costs. I'll kind of really gloss through this, but regular military, if you're putting like nothing down, it is, for the first time you use the VA loan, it's 2.15% of the loan amount. So if you're buying a $300,000 property, it's going to cost you like $6,000 and change in order to fund your VA loan. It's a pretty expensive funding, right? The good news is you can finance it. So you can actually go and finance 100% purchase at 306 now, or 306 and change. Okay? So I'm going to show you some actual numbers for different loan programs and what the monthly payment is, and VA is still really attractive even when you factor in this funding fee. Okay? All right, so types of financing. Here's another loan. It's called the CHFA loan. It is the Colorado Housing and Finance Authority. It is also NOMAD approved. There are 2 different programs for it. There is a $1,000 down program. Basically, it's an FHA loan with a CHFA, that's what we call it, CHFA grant. Fixed rate with PMI. It can't be canceled. The FHA PMI exists for the life of the loan. You do not get rid of it. At one point, it used to be once you get down to 75% loan to value or whatever the number was, the PMI would go away. You wouldn't have to make that monthly payment anymore for the PMI. FHA since changed their rules, and right now, PMI lasts for the life of the loan, which if you want to get rid of PMI, just means you need to refinance. So once you get down to 80% loan to value or whatever it is, refinance into a conventional loan. Frees up your FHA loan again, you can use it again. 620 credit score for this one, and you must own or occupy for the $1,000 down. So if you're not a veteran and you're not willing to live in Windsor, you can look at this and you have to come up with $1,000. Okay, that's one option to do it. The other loan they have is a 3% down payment and is lender paid PMI. So the lender is going to bump the rate up a little bit and they're going to prepay PMI so that's not part of the monthly payment. Okay, so that's actually helpful. And this one you have to have a little higher credit score. It's 680. Okay, any questions on CHFA? So if you're looking for really little down options, 2-0 down programs, VA or USDA if you qualify for those, or $1,000 down CHFA. Those are the order we have so far. Now we talk about FHA loans. What I like most about FHA loans, FHA is a government kind of backed loan product. It's pretty interesting in that it allows people with credit challenges to buy properties. This is the most forgiving loan product we have. So if you've got credit challenges, this is probably the one you're going to hit first. It's also interesting because you can buy duplexes, triplexes, and fourplexes with it if you're going to own or occupy one of the units. You do single family homes, duplex, triplex, fourplexes. So it's 3.5% down payment. It's fixed rate loan. It has PMI. It has both an upfront PMI payment and a monthly. And it doesn't go away. 640 plus credit score. You can go as low as 580 with some special circumstances. So if you've got a big hoard of cash somewhere, they will allow you to go down to 580 and get your FHA loan. But most of the time, it's going to be in the 640 to 620 credit score. The other nice thing is if you've had a bankruptcy, it's only 2 years to wait in order to get a FHA loan, 3 years for a foreclosure. You must own or occupy the property. You can do 1 to 4 units, which I've talked about. That does have maximum loan amounts by county. You typically can only have 1 FHA loan at a time. There are some exceptions. If you inherit a property that has an FHA loan, that's okay. If you move more than 100 miles away, you can have another FHA loan. And if you have some mitigating circumstance in your family, like you have 5 kids all at once and the property no longer works, they make an exception for situations like that. But they're really unusual. You should plan, you can only have 1 FHA loan at a time. FHA 203K loan, so where are my flippers near? So if you want to go buy a property that needs a lot of work, you can actually go own or occupy a property with FHA and do what's called a 203K loan, where you actually have the contractors come in and do work on your property and you can finance it. You only put 3.5% down of the purchase and the repair money. Okay, so you can do that loan all at once. It's a little bit of an unusual loan. You might have to go find a lender that specializes in it. There's a lot of extra work and it's a little bit more expensive because you have to escrow the money and have contractors do it. Can't do the work yourself, is my understanding. You can get down payment assistance like the CHFA stuff with FHA, and you can get 6% maximum seller concessions. Any questions on FHA? Is this helpful?
CHFA, do you have to ever pay the grant back, or is it just...
I don't think so. I think it's a gift grant. Yeah, they had ones that had loans at one point, but I'm not sure this one's that.
Do they still do the sliding scale thing where if you have it for a certain amount of time, they knock off a percentage?
Maybe it's like that.
That's the way they were doing them for a while.
Yeah.
They used to have big payoffs for them all the time.
These loan programs change, and so it's kind of tricky as to which ones are which. And so just talk to your lender and find out what the current program is. Okay. So conventional. There's also Nomad approved. Fannie Mae, Freddie Mac, that's who they're being sold to. It's a fixed interest rate usually and 30-year amortizations. Why not do 15? So if you're doing an investment property, why not do a 15-year loan? Yeah, usually it's because we want to have some cash flow, or it's negative with a 15-year loan payback. But you do get a higher return from debt pay down. How many people were here for that class, the arguably the best class of the year, part 2? Remember the return from 15% pay down loans? A lot higher, like double. Like you're getting 11% return from the 15-year loan versus a 5.51% return from the payoff on a 30-year loan.
It's also just flexibility.
I agree. Yeah.
Take a 30, if you're like, hey, I want to pay it off in 15, fantastic. Take a 30-year loan and make the 15-year payment and pay it off. And if something ever goes wrong, your mortgage company's not going to change it, right? You have a 15-year loan, you still got to make the payment.
I want to challenge you on that because I said the same thing to a client once. He went and talked to a lender at First Bank, and First Bank told them when they qualify them, if they have a 15-year loan, they actually use it as if it was a 30 because they would be willing to refinance it if somebody got in a cash flow position to a 30-year to re-amortize it. Right.
Will they be in a downturn?
This is what they said to this guy.
This is also, even in writing from
Yeah.
now,
Right.
that's now, right? But that's First Bank too, right?
Agreed. I totally agree.
It's a refi.
I understand. I'm just telling you what they said to this guy.
Unless there's a local branch of Fannie Mae in Fort Collins that I don't know about that I should go to.
They do not. I'm not aware of this. So 740 credit scores for the best interest rate. The higher, the better, typically. For owner occupants, it could be as low as 1% down. There's a 1% down program. It's actually a grant. It's really the 3% down loan program, but there's a grant to kind of bring you up to the 3%. And it's up to $5,000 is what the grant is, but if you're in lower than $250,000 price point, it's really a 1% down program, okay? So really most of the time it's 3% to 5% for the owner occupants for the low side. There is that 1% down exception with the grant. You can get these loans until you have 10 financed 1 to 4 unit properties, okay? If you and your spouse want to go and alternate, I'm going to show you a slide later, you can actually get 20 combined. So 10 in your name, 10 in your spouse's name.
And for clarity, 10 finance properties doesn't mean 10 Fannie Mae finance properties. It means 10 1 to 4 unit finance properties.
Good point. So if you got a portfolio loan from First Bank, that counts. If you co-signed on a loan for your kids at college, that counts.
Yep. If you have a private money loan on a property, that counts.
Maybe.
Well,
Depends on how it's structured. Could be in the name of the LLC, and then it's really technically not in your name. But we can talk about that, and the bank's going to look at it. So basically, we talk about 20% down for loans 1 to 4, then usually 25% down for loans 5 through 10. Now, there's an exception. There's a 15% down loan program. You could do that through 1 through 10. I have a feeling that the 20% down goes 1 through 10 now, too. I haven't heard for sure, though. Add an additional 5% down if you're doing a duplex, triplex, or fourplex. So if you're on your first property and it happens to be a duplex, it's 25% down. If you're on your sixth property, and it would have normally been 25% down, but you're doing a duplex, add 5% more, it's now 30% down for those. Okay?
does the 15% not kick in?
For duplexes and triplex, fourplexes? Yeah. You can't do them with it's single family home, owner occupant. Single family home, non-owner occupant.
Only single family home.
That's my understanding.
Down and it's loans 1 through 10.
Yes, that's my understanding.
So all I can say is if you are in a position to go do 15% down instead of putting 20 and 25%, man, it would have been great to have that 5 years ago.
You should hold what you're about to say until you see my monthly payment numbers.
Yeah, I know. But
Okay.
Just the sheer amount, you'd have to go do a bigger calculation than monthly payment.
Once you see the monthly payment, you may say maybe you don't need to do a bigger calculation. It's much higher.
Yeah.
Much, much higher.
Yeah.
All right.
If you're talking 5 and 10%.
We can talk about it. We'll talk about it. Yeah. For Fannie, you can do a cash out refi up to 4 finance, 1 to 4 properties. For Freddie, it's up to 6. So once you start getting over 6 properties, your flexibility in how to pull that money out is much harder. Now, Brian, when he taught his arguably the best class of the year, had a really interesting solution, which was HELOCs. And we're not going to go into a lot of detail, but that might open up some interesting options with that too. Rate and term refis, you can do up to 10 refinance 1 to 4 properties. So that's if you happen to get a loan, it's at 6% and rates are now at 4, you could go in and refinance, not pulling cash out, but just refinancing the term or the rate on the loan, and you could do that up to 10. You can get 2% to 9% maximum seller concessions. It's 6% with 20% down owner occupant, 2% for non-owner occupant. And new, you can do 15% down on 10 properties. We're going to talk about that on the chart. So once you get beyond 10 loans with Fannie Mae or Freddie Mac, you can actually go to a portfolio lender like First Bank, like Cash Bank and Trust, or any of those guys that they hold the loans in-house, they're not selling them. And you can get a loan. The challenge is that most of the time those portfolio loans are not 30-year fixed rate loans. They're usually ARMs. So they're usually fixed maybe for a short period of time, like 5 years, and then after that they become variable. So you're opening yourself up to an interest rate risk. And in some cases, not First Bank, but in some cases, there are balloons where it's actually a 5-year term. So at the end of 5 years, you actually need to pay off whatever the current balance is on that loan or refinance. And what happens if you have a loan and 5 years from now, lenders don't have the appetite to do loans anymore? Or maybe you have 12 loans now, and one of them you need to refinance, and they're like, we don't do loans over 10. So now you're really stuck. So be careful about these.
Many of those portfolio lenders also have, similar to the 1 to 4 with Fannie, it's like First Bank, 1 to 4, your first 1 to 4 loans with them are a lower interest rate. Your 5 through 10 loans are a higher interest rate, and above 10 is an even higher interest rate.
Yeah.
So you're tiering up with them as well. And there's some underwriting criteria, which James is going to talk about. I see it on the slide, but the DSCR, which is debt service coverage ratio, like it is counterintuitive to what you think. You actually need to, the more properties you have, the higher DSCR you actually need to have for First Bank, which doesn't make any sense. It's like if you're a new investor and you only have 2 properties, you can have a lower DSCR. But as you get more, they want it to be high, almost to the point where it's fairly unreasonable at the upper end. across
loans
your
you have?
portfolio.
Yeah, okay.
All across your entire portfolio.
Yeah, all loans. All right.
All properties, right?
Right. So talk about this. No limit on number of loans. You still have to be able to qualify. So there's no like, they don't say, hey, listen, we're cutting you off at 15 or we're cutting you off at 20. It is like a case-by-case basis. And I would tell you, once you get over a certain dollar amount that you have out in loans, you're going to loan committee. And so someone high up in the organization is looking at it personally and making a decision.
The other point on the loan committee that I would bring up is that there are exceptions to not having to go to loan committee, and if you don't ask, sometimes they just don't bring them up. So there's you need to be a strong borrower, right? But there's a presidential exception where they can just get it done right in the branch, one time, like once a year, and it's up to a certain dollar amount. So there's a bunch of different exceptions that can actually happen. So if you're like on that breaking point with the portfolio lender, ask the question, are there any exceptions that, might apply?
Yeah, that's a good one. Ask for exceptions. Fast underwriting, some are 24 hours. It still depends on the property. Debt service coverage ratio, that's what DSCR stands for. Bigger purchases go to loan committee, and the relationship with the bank, especially your deposits you have on deposit with the bank, matter. So if you go in there and you have a $5 account, which is what I had with them at one point, they don't like that. They'd rather see all of your banking being done at the one bank. And if you have all your bank stuff done there and they see transactions going through and money moving through and big balances, that's a big plus for them. They would much rather loan money to you than to someone else. And they may even say to you, hey, listen, we did that one loan for you with $5 in your bank account. If you want to do loan 2 or 3 or 4, you need to start bringing some of your banking over here and actually do some business with us. Okay? So that's a big factor.
And if you're banking somewhere that is a larger bank, like Chase or Wells Fargo or something like that right now, and you're considering ever using a portfolio lender, I would move your banking today to the portfolio lender that you're the most likely to choose, so that you're already there and you've been a longer term client. That will help you in the future.
Awesome. Thank you for sharing. All right, what else is on there? Nothing. Types of financing, commercial. So these are not typically Nomad-friendly type of things. So by the way, this is approved for Nomad, but usually only after loan 10. So we do our first 10, 30-year fixed rate financing wherever possible, and then we go to the portfolio lenders. But commercial loans, 5 units and more, we're typically not doing these for Nomads. Some banks may do commercial loans across 1 unit to 4 unit type properties, but most of the time they're focused on 5 units or more. It doesn't typically count against the 10 finance properties you have. So if you go and you buy a 24-plex, that does not typically count as a loan in your 10. Okay?
Which is awesome.
Which is awesome.
If you find a 6 unit and you were going to buy a 4 unit with conventional and you can buy the 6 unit instead, you still have an open conventional loan spot.
That's right. So it's really good for loan planning. Your LLC could typically borrow. You're signing for it personally in almost every single case. In fact, you'd have to get up really high, and the LLC would need to be very well established for you to be able to buy and not personally sign for those loans. Have you seen any exceptions to that?
Not in the less than 100 unit space.
Yeah. So that must be really, really big. And then even then, I know some people that are doing like those 100 unit things. They still have a signer for the loan.
Yeah.
A personal guy who's guaranteeing the loan. Loan programs vary and constantly change, and this is the wild west of loans, by the way. You're going to call up one lender, they can make up their own rules because they consider everyone very sophisticated investors up here, and there's no consumer protection for the folks playing in this kind of space. So just realize that. Relationship with the bank, especially deposits, can help a lot. Underwriting depends on the guarantor and the property, and then other requirements such as providing financials to the bank each year. So imagine for a second, they're requiring that you provide financials each year, and in year 2 you have a setback, and your financials are really gnarly. They could say, we're calling the loan due. Kind of a big deal. And most of these loans, they are not 30-year fixed rate financing. They're like, if you're lucky, 10 years, maybe like a 5-year at one rate, and then it adjusts 5 times over the next 5 years each year, and then there's a balloon in year 10, and you have to pay off the whole thing then. So it makes it much trickier to do kind of commercial financing and get it done.
And if you're doing higher, if your loan is more than $1 million on commercial, Fannie Mae actually has a commercial program. So
good point.
You can do Fannie Mae loans. They don't count as in your loan spots, but they are decent loans. And
they're not 30-year fixed though, are they?
no, but they are 30-year amortized, and the longest one I've seen is 12-year fixed.
Okay.
Right? So a 12-year fixed rate, 30-year AM is not a bad commercial loan. It's
No.
one of the better ones I've seen. There are other smaller lenders who don't perform as well, who do like a 7-year fixed, adjusts once, fixed for another 7 years, amortized across 30, which isn't a bad loan either, right? You've got one really big risk in the middle, but it's 7 years after that, so.
Yeah, it seems really reasonable.
Yeah.
All right, so other types of financing, and we usually don't use these for nomad stuff, but private money. And private money, difference between private money in my mind and hard money is private money are friends and family that aren't typically in the business of loaning you money. Hard money are people that are in the business of loaning you money. It's usually equity based, and so it's the property matters a lot, although you're still signing personally. So that's really where it is. So private money, friends and family, other private lenders, somebody who, grandma has, $1 million in CDs in the bank. You go to her and say, Grandma, you're getting 0.5%. How about I buy some real estate and I pay you 4%? And grandma says, that sounds like an amazing deal, Billy. Let's go ahead and go with that. More flexible than banks, it can be much faster to close. It is relationship based. If grandma doesn't like you, she's probably not loaning you money, regardless of your credit score. Still requires good financial statement, but screening may be easier. It's typically in the 4% to 8% range right now. May change over time, but it's really whatever you can get grandma to agree to. Hard money, typically for fix and flip or buy, fix up, and refi strategy, the property is very important to the lender. Does it support the loan? The typical one we're seeing around here for most cases is probably 70% loan to value. There's some lenders that have gone as high as 75, maybe even 80 for the right person who's very experienced, done a bunch of deals with somebody, but we're not seeing much higher than that for hard money. Borrower will be screened thoroughly as well, and a borrower is probably signing for the loan. It is not just property independent. It used to be at one point. We're not seeing that anymore. Typically in the 10% to 15% range of interest rates, and 1 to 5 points is typical.
And we've heard there's downward pressure on that lately.
Yeah, there's more money out there than there are deals. So we're seeing some downward pressure on hard money. For those, as an aside, because I have plenty of time, which I don't, for those that want to go eventually into being hard money lenders, the challenge with the hard money lender business is, let's say you have $500,000 that you want to get out. And somebody comes in, they borrow $200,000 of it, and it's out for 6 months, but then it comes back and you're sitting there not making any return on it while you're waiting for the next person to come. So you might be getting 10, 12, 13, 14, 15%, but it may only be for half the year at a time. And you've got a whole bunch of money that's not being used. So it's not like you can put the whole amount to work and keep it out all the time at that rate. So you really, if you look at a lot of the hard money lenders that I know of, they're not seeing anywhere near this number. A lot of them are seeing closer to 7 to 8% when everything's said and done. So partnerships have someone else sign on the loan or sign with them. That's another way to get loans done. Realize for this, if both people are signing on the loan, it counts as a loan spot for both of you. So it takes up your loan spot, takes up their loan spot. Some other financing options, again, these are not suggested for Nomad. Home equity loans, line of credit. Brian taught a whole section of class on that. Taken against personal home is the most common. In some cases, you can do rental properties. It's used when and only if you need it, although there's a whole strategy on how to pay off your houses faster using one.
And you're going to implement that into
In the new Nomad calculator.
Nomad, right?
Yeah, it's not done yet. I haven't even thought about it.
Strategy for now using home equity lines of credit for doing Nomad, which is super compelling. to
Haven't thought about it yet, so I don't know if it's super compelling. At first glance, it looks really interesting, but right now I haven't thought about it, so I don't know. It can be also for the buy, rehab, refinance, rent model as well. Oh, I actually had it written out. That's good. I was like, which one is this? Owner financing, yeah, Burr. Great if you can get it. Can typically offer more than the house is worth if terms are right. That's a strategy that we don't really teach a lot, but we've taught it during the owner financing class. It's a possibility. Right now in our market, when we're seeing a lot of offers being made above asking price, all cash or with financing closing within 30 days, the chance of you getting owner financing is really low. Just really uncommon. You can do all cash, life insurance, Roth IRAs, things of that nature. Talk to your professional specialized in these. We've done classes on using IRAs and using retirement accounts in order to fund deals. Go see that class. It's like 2 hours long. Creative financing, again, these are not usually for nomads. You could buy on a lease option or a lease purchase. So you find a seller that wants to lease the property to you and gives you the option to buy it from them, or you lease the property from them and they have a purchase contract for you to be able to buy it from them in a year or two. That's one option for doing it. It's not really buying technically until you exercise your option. So really, you're just the tenant until a year down the road. When you exercise your option, you buy the property, or you exercise your purchase contract and you buy the property. So we don't typically do this. usually need to put out marketing to find these. So these are not ones you can find inside the MLS. They're extremely uncommon. You're going to need to spend marketing up front in order to find them, and then you're going to need to be a sales animal, go out there and actually make presentations to sellers as to why this might be a good deal for them and convince them to do them. Subject to, which is actually usually wrap financing. I use subject to for the people that don't realize it's supposed to be wrap financing. If you're doing subject to deals and you're actually not doing it as wrap financing, the Consumer Protection Division in Colorado's Denver area, they'd like to talk to you, and it's not going to be pleasant. So you really do need, if you're going to do these, the attorneys suggest strongly that you do them as wraps. Do not buy a property where the seller just deeds you the property and there's no protection in there for the seller leaving the property. So do it as a wrap. So we don't typically do this. Usually need to put out marketing to find these. We've taught a whole bunch of classes on these kind of creative solutions, so I'm not going to cover them tonight, but there's a ton of stuff on subject to and lease options and things. So see those additional recordings if you're interested in doing this. All right, so I'm going to give you, or you guys got in front of you, can I borrow yours again? You're my volunteer tonight. You got in front of you this crazy chart with a little bit of, chart in the background, a table on the front. So there's lots of moving pieces in this. Please don't use this and go to your lender and say, I would like column 3, that loan, please. Because you have a different interest rate. Interest rates change every day. So this was from the 9th of October. Today's interest rate are probably different from the 9th. They vary every single day. I remember a client of ours, I can't remember who it was, but a client of ours was going, I know exactly who it was now. A client of ours was going to look at a property. This was like the night of the election. And they were like ready to write an offer. They knew what their interest rate is because they had called their lender that morning or the day before. We go home, the election happens. Oh my gosh, a little bit of a surprise for a lot of folks. The next morning we wake up and interest rates are like half a point higher. Now, interest rates changing by like 1/8 can affect your cash flow. Changing by half a point, that's pretty significant. So the property no longer worked after that. Okay? So interest rates change, lender fees change. You may go to a different lender and they may say my fees are different, or I charge a $500 admin fee, or my appraisal is $900 or whatever it is. Closing costs may vary. The seller concessions we negotiate in the contract between you and the seller are going to vary, and so you may have to come out of pocket less or more depending on what we're able to negotiate. The funding fees may vary, like VA, we showed that sheet that shows you different funding fees. If you're in the reserves, your funding fee is different. If it's your second loan on VA, it's different. So there's lots of different factors that go into this. And your credit score especially are going to affect the rate and PMI. So if you think for a second that this is like locked in stone, don't fool yourself. This is like a, let's kind of see how some of these play out on one particular day and time for a fictitious person. Your numbers are going to be different. Okay? Does that make sense? This is for illustrative purposes only, or illustrative, or however you want to call it. All right, so here's the chart. So what I'm going to walk you through is what's going on with this, and this is my new invention. I thought you guys might like this. So basically, this is the different loan programs. I broke it down into government programs. That's the FHA, USDA, and VA. Does everyone have a sheet? Is there anyone who's missing a sheet? Okay, good. FHA, USDA, VA, and it shows you the loan kind of going down here. Then these are all the different conventional programs. There's the 1% down. That's basically a $5,000, up to a $5,000 gift from the lender. One of them is monthly paid PMI. The other one is the lender paid upfront PMI. Then we've got 3% down as the two options, a monthly PMI and a lender paid PMI. 5% down, a monthly, and then a lender. And then you've got the two CHAFA loans. This is the 3% down one, and then this is the $1,000 down one. And then on the end here, you've got the non-owner occupant, 15% down and 20% down loan programs. And Brian, I fear he's actually checking my math and telling me I've got a math error.
No, from the thing you said earlier, I'm interested to see, like, plan out the 15% versus the 20. I'm curious, is the rate always slightly higher for the 15%?
Yeah, that's what the difference is. This is like the same credit score being quoted simultaneously, the two different programs, which is why it's insane. Yeah.
So the rate's higher.
And PMI.
Yeah.
So when you okay, we'll get to it. All right, so let's talk about the government loan program. So FHA, remember, it's 3.5% down, so we're putting $10,500 down. Oh, by the way, the same $300,000 property for all these. So we're assuming it's the same $300,000 property. We're going to say it's a $300,000 property. You're putting $10,500 down. You're getting a loan for $289,500. Does everyone follow along? Anyone missing it? Okay, cool. You're going to pay an upfront PMI payment of $5,000 and change. And so you're going to finance that. And so you're really borrowing $294,566. Your interest rate on this particular one is 4%. Decent interest rate. Your principal and interest payment is going to be $1,406 but your monthly PMI is $209. You're paying a monthly PMI payment of $209 a month. I'm estimating your insurance is going to be $100 a month and your taxes $188. So taxes and insurance, I assumed it's the same because it's the same property. Everyone make sense? Okay. So your total payment is $1,902 for an FHA loan, 3.5% down. This is assuming a credit score of 660, and your minimum for that particular loan program is 580. Does everyone follow along what I'm doing here? Okay, cool. So there's a couple things I want to point out here. Number one is just glancing at the three government down programs. If you do USDA, it's $1,822 for nothing down, but if you can get VA, it's $1,751. So VA is a little bit better. The next one's over, the 1% down. There's either a monthly mortgage payment, so you can go down here to this monthly thing. You'll see $186 a month for someone with a 720 credit score, where they only had to put 1% down or $3,000 in this property. And then over here, if you have this one, the 1% down lender paid, there's no upfront, there's no monthly PMI, but you do have an upfront, a higher interest rate for the lender to take on that PMI payment. So basically you're raising the interest rate and the lender's paying the PMI upfront. So it's a half-point difference to do that. So the difference in payment, though, is $1,905 and $1,805. It's $100 more if you decide to pay your own PMI. It is $100 less if you get the lender pay PMI. So you'd say to me, James, why would I ever pick the one where I get the lender to pay it? Why would I get the other one? Or would I do it? Why would I ever pick the one where I actually pay the monthly PMI? Right? You say to me, why would I ever do that? Well, because PMI goes away with conventional loans after a period of time. So once you get down to 80% loan to value, the PMI, this monthly number, 186, goes away. So you really are only paying this PMI for, in our market, if the market's going up 10% a year, 2 years. In a normal market, 7 years. Before you get to the point where PMI goes away. So depending on how long you plan on holding the property, it can make a big difference. You can either have, 4.75 for 30 years, or you can have 4.25 with $186 PMI for 5 years, 7 years, whatever it is, and then it goes away and you're actually lower than this one. You're $85 or whatever it is lower than that. Yeah?
You just have to have it reappraised and it'll drop?
Yeah, so each lender has their own criteria as to how they do it. So talk to your lender about the criteria for doing it. Yes. Okay? So it's kind of this weird twisty thing, right? Where you're looking at it, you're like, if you don't understand that difference though, and you go and look at it, it's like, well, I'll pick the lower one. What is it? I mean, is this a trick question? Yes, it's a trick question. Okay, 'cause you have to think it through as to how long you're going to do it. And so that kind of model applies to these other ones too, with the 3% down, 3% down. Now, why are the payments for 1% down and 3% down the same? Because the 1% down program is the 3% down program. The lender is gifting you the other 2%. Okay, that's why they're the same. 5% down, here's the monthly MI and the lender pay PMI. You can see the difference there. Now, the one that was really interesting was that $1,000, the Smart Step Plus Chaffa loan one. That payment is $2,105. It is really high. How is it possible you're putting $1,000 down, your payment's much higher than if you put nothing down? Better to do the nothing down program. Okay? And then investment loans, there's the 15% down one, where you're basically doing that, but you have a monthly PMI payment of $128, or you put 20% down and you don't have PMI because that's the criteria. So once you get to 20% down, you no longer have PMI criteria, and so there's a difference in payment for those. Okay? Interesting thing about the 15% down, the credit score we quoted is 720. You have to have 720 to do the program. It's the minimum. So this 15% down non-owner occupied one is for good credit risk only. Okay? All right, so this is the chart you have on the back. I just want to show you a couple quick things. This is relative differences between all of the loans on the other side. And so you can see whatever the loan program is, and they're in order in case you're trying to figure out what the color is in your black and white version. But it shows you the dollar amount on top of each block. What's this one? $2,105. What loan was that? That's the $1,000 Chaffa program. But what's crazy is, so this one was $1,902 was the FHA, If you can get USDA, and that's 3.5% down. If you can get USDA, though, it drops by almost $80 for putting nothing down. And if you can get VA, it drops by another $70 if you can get a VA loan. Same property, same day. So if you can get VA, let's do VA. It's like one of the best loans you can get, besides putting 20% down, right? It's like one of the most amazing loan programs, even though the upfront fee seems high. And we're adding that in, so you're financing it. So it's sort of like that priority. And then here's the 1% down options, the 3%. So if you can qualify for the 1%, why not do it? You get a $5,000 gift from the lender. Then this one over here is the 5% down. And so the difference between putting 1% down and 5% down, or $12,000, is really $60 a month. $60 a month or an extra $12,000. Which one would you rather do? Would you rather put up an extra 12 grand, or would you rather pay $60 a month on it? How long would it take you paying $60 a month to have an extra $12,000 put in? Well, that's $720 a year. So that's 10 years plus more, like almost 17 years, 18 years, somewhere in that ballpark. That's a long time, right? Is my math wrong? It's hard.
You say 50 a month?
60 a month, so $720 a year. Long time, okay? And then over here you could see this is the 20% down, and this one is putting 5% down less, which is, I don't know, what's that, $250? Somewhere around there? $276. So you have to pay $276 more per month to not put up an extra $15,000. That one's less clear to me. You pay $276 more, $247. So let's call it $250. Put up $250 more per month to not have to come up with $15,000. So over the course of a year, it's $3 grand. So within 5 years, probably would have been better doing it the other way.
Now, hang on.
Oh, wait, Brian's going to teach us some math.
Stop and think for a minute. If it's in Fort Collins as an example, and we assume that depreciation is 4%,
Yep.
which is the median over a long period of time, which it may not be in the year
Well,
you buy
it's
the house.
more like 3%, but yeah. 3 to 4.
Approaching 4.
3 to 4.
Yeah, fine. I used 4 because that was
Okay, that's fair.
lately. So at 4, basically with your loan pay down,
You get it in like 2 years or something.
it's 1 year.
Well, I think you have to go more than 80. It's
Yeah,
like
78.
it's like whatever it is,
So
yeah.
let's call it a year to a year and a half, and at that point, maybe you paid $4,500 extra to save yourself from having to put 15 grand down. That starts looking a whole lot.
It does look a lot better when you say it that way, because you're basically saving 10K.
Right, and now you got 10K for reserves or for your next property or whatever else. So
Valid point.
now, if your appreciation, this takes a complete dump in the first year and it goes down 10%, well, now you got a problem.
Yeah.
But if it's 2 or 3% and you're there in 2 years or even 3, it probably makes sense.
I would agree. Yeah.
But there's some weird, you also had 5% down more on the other one, so doing a comparison, I need this spreadsheet.
Yeah. Yeah, it's interesting though. So what I thought was pretty cool to see though is seeing these different loan programs all laid out side by side, and then seeing what the difference in the monthly payments were for doing these loans. Where in some ways, it's actually more expensive to put less down than it is to get 0 down in some ways, which is just weird to think about. Okay. Lender programs vary, so just because one lender you talk to says it can't be done, it does not necessarily mean that it can't be done, as we talked about the overlays and stuff. Different lenders have different loan programs. Different lenders look at things differently and may be willing to do something that other lenders won't. And so we'll be discussing what most lenders will do. Probably should have had that slide at the beginning. All right, some advanced strategies. So plan your loans. We talked about this throughout the night. If you and your spouse are doing loans and you're both signing on them, you are limiting yourself to doing 10 loans between you. If you alternate, if your wife gets one, your husband gets one, wife gets one, husband gets one, wife gets one, husband gets one, you can do 20. Fixed rate financing, 30 years, okay? You must be able to qualify for all of them. Your personal residence counts as one. Portfolio loans and other 1 to 4 units count against the 10 as well. We talked about that. Fannie and Freddie loans are important, yes, because they are 30-year fixed rate loans. That's why they're important. That's why we make such a big deal out of these 10 loan spots. Those are 30-year fixed rate loans. Important kind of point. So after the 10, we talk about using portfolio, and then the commercial loans don't count. So use those first 10 loan spots wisely. Don't do variable rate loans with one of your loan spots early on. Have a loan plan. And there's someone in this room who did not quite think through their loan plan in advance, and ended up having to put more down than they really probably wanted to. If they had thought it through, it probably would have done it a little bit different order. Okay, advanced strategies, changing rate, can raise interest rate and have a lender pay some of all of your closing costs. We talked about this idea already, so I'm not going to cover it again. Lower interest rate by penny lender points. 1 point is typically 1% of the loan. Have you ever heard a lender say, it's 1 point? That's 1% of the loan amount you're getting. So we have some stuff in here about how to improve cash flow. There's a whole class on how to get the lowest monthly payment when buying. So you can go watch a 2-hour class on that. And then there's a class called Cash Flow Explosion. In that class, we talk about how to increase rent on properties. It's a 2-hour class on how to do that. And so with these two combined, how to minimize your payment, maximize your cash flow, it maximizes your net cash flow after expenses. Is it better for cash flow to buy down the interest rate or to put more down? I'm so glad you asked. That's a 2-hour class we do. So I can't quite answer the question because it really depends. In some situations, yeah, it makes sense to actually do it one way. The other situation, makes sense to do it the other way. What? You don't agree with that?
When does it make sense to put more down?
Oh, it depends on the interest rate and how much the bumps are.
Yeah. Almost every case it makes sense to buy down.
I don't know if that's true.
Yeah.
Depends on your holding period too.
Yeah.
Financing for nomads. So Nomad Loan Basics, preferred order. So if you're a nomad in the room and you want to know what the order we recommend is, in theory, VA first, get a duplex, triplex, or fourplex if possible. Don't wait to find one though. Don't delay doing Nomad to find a duplex, triplex, or fourplex. They're really hard to find. But then if you can't do VA, if you don't have the ability to qualify, do multifamily FHA next. So duplex, triplex, or fourplex with FHA. And if you can do VA, you do VA, then you do FHA after that. So you can do one with your VA kind of eligibility, and then you do one with FHA. Then after that, you do your conventional, fill through 10, and then you do portfolio. Okay, that's kind of the model. You could also refi your FHA and use it over again if you really want to. That's another strategy. So owner-occupant financing. If we're doing nomad stuff, these are owner-occupant loans. It means you need to move into the property. Can you just sort of, show up at closing, pretend you're moving in, maybe pack the moving truck but don't put anything in it, kind of show up at closing, sign the documents that say, yeah, I intend to live here for a year, and then actually never move in? Oh, I changed my mind, we decided we're not moving, we like the other house better, we can't do that. What's that called? There's a name for it. What is it called?
Fraud.
Yeah, loan fraud. And actually, if you think it's a joke, Brian had a tenant of his who went to prison for loan fraud. Like, no joke.
Chase Bank knocked on my door.
To make sure you were living there. Yeah, they do. They do occupancy checks, guys. This is serious stuff.
Yeah.
Okay.
What was the time period that they knocked on your door?
It was like 2 months after I bought the place, and I knew why, because I finished grad school and I was living in my parents' basement, and I bought my first place, and I didn't switch my address. It was still going, my mail was still going to my parents' house. And so 6:30 Saturday morning, Chase Bank guys, they made me show a photo ID, they made me...
Yeah.
Did they give you ID first?
He had a shirt with a name tag
A
on it.
badge from Chase.
Yeah.
You can get those going to a golf tournament. They give them away.
He showed me the name tag and everything, and then he told me why he was there, and then asked if I had a photo ID.
Yeah. I had a friend of mine who used to get paid by banks to do that. He'd spot check. Yeah.
I'd been like, do you have a photo ID? You need to make a copy of it.
Yeah. I was talking to...
Yeah, right? That's why they do it at 6:30. They're like, we just woke you up. We're like, what? Yeah, sure. I live here.
So people knocking on the door, I was talking to some millennials recently, and what they told me was, if someone knocks on their door, unless they're expecting someone, they won't even answer. They're just like, they're like, I'm not expecting anyone. Are you expecting anyone? No. Let them go away. Yeah, it's just really weird. All right. So if you're modeling how much income you need, if you're thinking, okay, I want to buy a property every year for the next decade, and you're going to do the nomad model, and you're going to put, I think this is modeling 5% down, but if you're going to do that, how much income you need to earn, this shows you the minimum household income you need to earn per month, assuming you have no other debt. So in year one, you need, and this is a $300,000 property, I believe. So you need to earn $3,438 a month, assuming no other debt to qualify for a $300,000 loan. $42.15 per month in year two. And by the way, this is household, so this would be you and your spouse earning half of this. So you can earn $2,000 and change each, have no other debt, and do that. And by the way, if you have other debt, if you have like a car loan, the car loan's, I don't know what a car loan is, $400 bucks? Is that what a car loan is these days? $400, then you need to earn $800 more to cover a $400 car debt. So add $800 to this if you have $400 in car debt. Okay? So basically, by the time you get to year 10, between the two of you, you need to be earning $8,578 per month each, assuming no other debt. And this does take into account the rents you're getting from this property, and it's handicapped because this particular property had some negative cash flow. Okay. Yeah.
Quick question.
Yeah.
As you're adding more loans.
Yep.
They're not revolving credit card debt, but do they have a negative impact on your?
They do. They count to your debt to income ratio.
Yeah. So basically, if you're not in, you're going to have high loan to value loans stacking up.
So it depends. If you're actually positive cash flow on them, then it actually helps you. If you have negative cash flow on them, it hurts you by whatever the negative amount is. And they use some ratio like 75% of the rents coming in.
Okay, so it's not the amount borrowed versus owed, it's the cash flow?
Yep. It's your cash flow on the property.
It's your ability to cover the debt, right? So that's what the debt service coverage ratio is how much debt do you have to pay on a monthly basis? How much income do you have coming in? And they calculate a ratio.
But on your FICO score?
Well, it may impact your credit score. But your credit score, I mean, provided it's within range of doing a loan, you're going to qualify.
Yeah, so when you get a loan, your credit will typically come down a little bit. And if you get a bunch of loans in a short period of time, you'll definitely see a dip in your credit score. But then
But you're doing these every year.
they become longer, right?
Yeah.
The term of that credit is why it's dinging your credit score. So the longer that term goes, it will very quickly come back up.
And you can work on your credit score. If you're able to get into the first one, let's get you into a credit improvement program while you're there for the first year. Let's try to bump up whatever your income you're going to get on it, so that can help you when you qualify for it. And let's bump up your income if we can, your regular job income, and pay down debts.
About like loan 5, 6, 7.
I agree.
You know, if you're not able to stay in that 720, 740 range.
Yeah.
Get the preferred rate.
Yep. Yeah.
Once you're there,
It helps. The rents from the previous ones help. Because if you're having rents go up at 3% a year, whatever it is, they definitely can contribute. So we're trying to be really conservative in our modeling of this. All right, accessing equity in properties. You can do cash out refinance. So let's say you have a ton of equity in your property. You can go and get a new loan and actually pull out some cash up to usually 75% of the loan to value. That's usually what it is for non-owner occupant. For owner occupant, you can do higher than that.
Does that change your owner occupant status? So like if you're on your second or third one and you refinance the first one?
You're not living in it anymore, you are living in it.
Move back in?
No, you could do it as a non-owner occupant, but you're only getting 75% loan to value. So you'd have to move back in and restart that year-long process in most lenders' cases if you're going to do a refinance there. So some people say, well, you know what I'll do? I'll refinance right before I move out. What's that called? Loan fraud. Because you're signing something, most of the times when you're refinancing, if you're doing owner-occupant rates, that you're staying there for at least a year. Okay, so you can't pull out equity and then move out of the property the next day. One suggestion is to get a second lien, then refi both of them when the new first. That's a way to actually do a rate and term refi instead of cash out. The new loan is really just rate and term. Check with your lender before you do that. Some lenders, they want it seasoned for a period of time. Use a HELOC to access funds as needed. You can put the HELOC across multiple properties in some rare cases. You can get a second lien, typically more expensive than a first, and many won't do it, especially if you're going higher than 80%. You can have a partner invest, give a portion of the current ownings of the property to get cash out, and then buy another property and repeat. And you could sell it, consider 1031 exchange in order to access that equity. That's the short version of how to access equity in your property. And Brian did a really interesting class where he talked about using HELOCs. And we don't really focus a lot on that, but there's some new stuff that came out of that HELOC class that we probably should add to this presentation in the future. So you can update your presentation. This is yours, right? I'm telling you, I may have added to it and modified it, but it seems like a lot of it is yours.
I'm like, it seems like I wrote that slide.
Exactly. All right, get your financial house in order. Like, this is going to seem really familiar to me. Yeah, because I never say that term. All right, so know your credit report and score from all three credit agencies. Your middle score is typically the one that is used by the lender. So they ignore your low and they ignore your high and they use your middle one. Look for anything that is incorrect or inaccurate and fix it. Resolve negatives on your report. Consult your lender or credit counselor for ways to raise your score. And it is not always as obvious as you think. You think to yourself, oh, I've got these 6 credit cards. I'm going to close them all down. That should improve my credit. That's not how it works. So be super, super careful. Talk to your lender before you go and do anything crazy. And it could be stuff as minor as, I had a client of mine, I love telling this story, had a client of mine, they were a brand new couple, just got married, they were under contract to buy a new construction house, they were heading into their closing, 2 weeks before, they got married, they show up to the bank, and they want to open a joint checking account because now they're married. So the bank says to them, so we're going to open this joint checking account, would you guys like overdraft protection? They're like, yeah, that sounds great. Let's go ahead and add overdraft protection to our checking account. What'd they just do? They opened up a new credit line, and it actually impacted their score. Their interest rate went up on their loan, and they ended up paying more on their mortgage payment because they were that close. So yeah, it has an impact. Be super careful about stuff. So use Credit Karma or whatever service you want to, but I know this one's free. Free service that is not exact on your credit score, but it's a decent model to give you an idea, and it lists some of the things on your credit and how it's impacting it, how important it is.
Yeah, and if you're looking at, I have to say this, 'cause I don't know Credit Karma how accurate they are with your credit score.
I don't think they're super accurate, but they're in a ballpark.
If it's anything like I have a Citi card, and they give you your free credit score, and I will tell you, I have a good credit score, but like Citibank thinks it's like 890 or something crazy. And I'm like, it's not 890, right? It's like 800, but it's like whatever system they're using to determine what my credit score is, it's not real. So if you're looking at that and thinking, I got above a 720, you may not.
Yeah.
You may actually have a 600, and they're telling you it's 800.
Yeah.
So be careful. You can also pull your credit for free once a year from annual credit report. So don't get suckered into paying for everything else, but pull your credit report every single year and look at it.
It doesn't do your score, though, on the credit report one. It just shows you your...
Yeah, and you can pay like $7 to get the score. Or if you were affected by the Equifax recent thing, you can go and get your whole thing for free and see that stuff too.
In fact, Equifax, if you go to their website, you can sign up for the credit monitoring for free.
Yep.
And they've got a really good looking report out of your credit report, easy to read, and it's free now.
Yeah. Curtis?
The suggestion I heard was because there's 3 major credit houses, and you can get one credit report free. You get your report from one credit house. 4 months later, you get.
Yep. And then you can check it basically every 4 months by alternating through the 3. Yep. Yeah, that's a good idea too. Okay. Understand your debt to income ratio. The lower it is, the better. Get organized and digitize your documents. So if you know you're going to need to provide all your bank statements and your previous tax returns and stuff, and they're not in digital form, you might as well do that now instead of when you're under contract and scrambling to do 90 other things. If you're self-employed, expect 2 years of returns will be needed to show increasing profits year over year, and don't overstate expenses to minimize taxes. I see this all the time. Self-employed people are always like bragging to me, I made $100,000 last year, but I actually, on my taxes, I only made 20. Because I wrote off 80 grand in expenses. Aren't I really smart? And I'm like, yeah, good luck buying a house now, buddy. Because you just basically said you only make $20,000 a year. So you just screwed yourself over.
And they're done that.
Yeah, don't do it, right? This is like the team part of being your lender, right? You call your lender and say, listen, I'm not doing a loan yet right now. I already did one 2 months ago with you. I'm going to do one 12 months from now, but I'm about to go file my taxes and I'm self-employed. Talk to me about what you're going to need to see in order to qualify me so that I can just do that amount but not more. So I'm only paying the tax I need to, and I'm willing to throw away some exemptions so that I can get loans. Because it's no good doing that thing when you can't get loans.
And on the flip side, don't overstate your income if you don't actually have it if you're self-employed. It's another common way.
Well, people will document. They need to document their stuff.
Yeah, but tax returns document, right? Like I can say, hey, I made $100,000 this year and I've got a cash-only business.
It never even occurred to me. What kind of criminal mind do you have that you would think of overstating your income on your taxes?
I didn't think of it.
Oh.
I had a particular person who was trying to buy a house.
And they told you they made that much money? That's crazy. All right, cool. So budget and save your down payment and your reserves. We've had some discussion about reserves. Let's do 2 years, everybody. All right, contacting lenders. I'm going to breeze through some of this stuff because I think I'm behind. Finding a lender, call multiple banks and or mortgage brokers. So don't just call one, and don't do this. Don't call one on Monday, one on Tuesday, one on Wednesday, one on Thursday, and think that you're going to get similar rates. Because it could have been like the day before an election or something crazy happened, and the rate for lender one could be half a point lower, and the next person could be half a point higher, when the second one's fees could be a lot less and give you the same rate. It's just the rates changed. So if you're going to do this, do all of it on the same day. And don't have 4 different lenders pull your credit on the same day either. That's not fun either. What you do is you tell them, My credit score is 720. Give me quotes as if I have 720. If I decide to go with you, I will have you pull my credit and verify at that point. Believe me now, verify later. Okay? I want to get quotes today from 4 different people, and I'm checking that. If you use a random person, random chance of closing, that sounds like a Brian saying. Attend local Nomad Investor Club meetings, meet lenders and local real estate agents that can refer you to lenders. It may find it more difficult if you go to the big banks versus local banks and brokers. That sounds like something Brian would say too. Especially if you have more properties and loans, don't use the huge online sites either. That is totally Brian. This is your slide.
Yeah, so a couple comments, right?
Since he's teaching from the back of the room anyway.
Like, if you use a random person, like if you call up a bank and you don't have a relationship and you don't have a referral, and it's great if you're trying to build one, but if you're just like, hey, blah, 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 and you don't know them, I mean, find somebody that's good, right? And the big banks versus local banks, like, I don't have anything against Chase or Wells Fargo or any of those banks, but they are in the business to do the majority of one type of loan, which is single-family home, owner-occupant, standard loan, right? When you show up and you're like, hey, I've got 8 investment properties and here's the rent, that's totally new for most of those guys. They don't see that every day, right? Yeah. Where First Bank, they're totally used to it. They're like, send me your tax return, we'll calculate your DSCR, we'll make sure you can get the loan, right? They get it. So find a lender who understands investing.
And if you're doing Nomad, it really makes a difference if you have a lender that understands what you're doing with Nomad. Because when you tell them, I'm going to convert this to a rental after you, they're like, what? How does that work? And they start asking you all sorts of weird questions, which you may not be able to answer. So if you have a lender that understands it, they can really help you with that.
And the huge online sites, I had somebody try to exercise a lease option based on the online site, and they're like, yeah, and they like didn't even understand what they were doing, right? Like they had no clue what was about to happen. They actually made her order an appraisal that she had to pay for, which she didn't need. It was a bunch of craziness, and nothing ever got done. It was months and months and months of trying. Did it close?
No.
This is the one you just pulled out.
All right, so calling lenders, part 2. Ask for rates. Do this on the same day. We talked about that. 2 options. If you know your score, don't let them pull your credit yet. Only the one you eventually choose. If you don't know your score, have the first one pull your credit, and then tell the other ones my credit score is blank. Ask questions that are important to you. This is going to be some of the next slides, which I'm going to really skip through very quickly. Find someone you can communicate easily with. We talked about that at the beginning. And are they timely in responding to you? And will they go the extra mile to help you get approved? That's Brian's slide. You're not teaching it again, though. All right, so questions to ask the lender. These are the basics of this. If you want to get access to them, jamesor.com, mortgage broker interview questions. Just write down mortgage broker interview questions and search jamesor.com, mortgage broker interview. You'll see all these on there. I'm going to skip them. There are some reasons why we ask certain things, but you can go read through them. And this is only a sampling of what's on there. There's like 4 slides with all sorts of questions. There's ones on fees. There's ones on, you know, if you're going to be working with that broker. Because sometimes the broker is the business generator. They're the rainmaker. But you never, ever talk to that person again once you tell them you want to do a loan. It's always one of 7 assistants you're talking to. So realize, ask them if you're going to be doing that. And if it's important for you to talk with the main person, just know that you're going to be talking with the assistant and decide. This is sort of my question for screening out people that say that they never have any complaints with people. So there's some stuff on there about that. All right, applying for a loan. So you'll likely be asked for the following and more, including your firstborn child. That's Brian's joke. Loan application, personal financial statement, color copy of your ID. So these are the things you may want to pre-scan. If you know you're going to do it, put it in a folder on Dropbox. Then whenever the lender says, hey, I'm going to need your stuff, you can just send them everything in the Dropbox. Recent W-2 and pay stubs, so proof of any source of income. The last 2 years of tax returns. All bank, investment, IRA account statements for the last 3 months. Documentation of where the down payment is coming from. Documentation of any large deposits into your account. So if you're dealing drugs, make sure you spread that out. Leases, insurance, HOA, mortgage statements for all properties you own, and then a HUD-1 or settlement statement from recent purchases in case you've got any of those. That's sort of your list. Applying for loans, tips for nomads. If you know you'll be doing this again, create a process for yourself. Store it in one folder and always keep that folder up to date so you're ready to go. Highly suggest creating a folder. We talked about that. Dropbox works great, and you can send the lender the link. Some lenders require you to upload stuff to their own portal. I still just send them the link if I were you. So you do it. It's full service, right? Okay. First meeting with your real estate agent. So we talked about financing. Yeah, we got a lot to go. We've only covered one of like 9 things. We're going to talk about writing offers now. So by the time we go to write an offer, you will want to have, at a minimum, a pre-approval letter. And most realtors will not take you out looking for properties unless you've been pre-approved with a lender and you have a pre-approval letter. Okay? So some lenders are having borrowers go completely through underwriting with a property before they actually approve them. So it's not just tell me your income, tell me your expenses, okay, you're pre-approved at the 300. They're saying let's send you through underwriting with a property that is to be determined, have the underwriter give them a full okay approval, ready to go, and that's a little stronger, and that's better, especially in our market where we have to make multiple offers and highest and best and stuff like that. So when you do this the first time, because you're not going to have a property in mind, get your max. Even though you may say to me, James, I'm really only comfortable going to 300, I'm telling you, just have them give you the max one. We're going to try to get one that's exactly for what you're offering, but if it's 7 o'clock at night and you happen to bump up your price and you didn't think you were ever going to go above 300 and you went to 340 or 370 or 400 and you're like, I only have a letter for 300. I'd rather have your max so that we can use your max if it comes down to it as a last resort. Don't wait till your last minute. I don't know how many times this happens. But they basically, they go and they get qualified with the lender, and the lender, for whatever reason, doesn't give them a pre-approval letter. They're like, yeah, just call me whenever you're ready. I'll write one up. So 4 o'clock, you're sitting at your office desk. A property comes on the market. You're looking at the website. You're like, I love this property. James, can we go see this property tonight after work? 5:15, meet me over at the property. I'm like, sure, let's go do it. 5:15 shows up. We go out there at the property. It's the first one you looked at. You're like, this is amazing. This is the one. I need to have this property right now. And you're not quite prepared yet. Your lender, you try to get your lender on the phone. They're at their kid's soccer game, and they're not going to be home till 9 o'clock at night or 10 o'clock at night, and there's multiple offers on the property, and we're already late because someone else saw the property the other day, and they're making an offer, and they're going to make a decision tonight at 8 o'clock, and your lender hasn't gotten you the letter. It's a real issue. So make sure you have your lender letter before all this stuff happens. And we'll try to get your lender to give you an updated one, but if they can't, at least you got one that's maxed out. Okay? Yeah.
How long is that typically good for?
If nothing's really changed in your financial situation, probably a while, but lenders probably want to update them every once in a while. And most sellers agents are going to call the lender once they get your offer. If you're in the running, they're going to call them and verify that you really are. And you want a lender who's going to go to bat for you, which is another problem with going with these online websites and things like that. There's no one to call and say, oh my gosh, Brian is amazing. He can get this done. He's well qualified. You're not going to have any problems. We're going to fly through this thing. So you want someone who's willing to do that, a lender on your team. All right, working with a real estate agent overview. So we just did the first meeting. Now we're going to talk about pre-showings, qualifying with lender, getting the pre-approval. We talked a little bit about this already. Call one or more lenders, get pre-qualified. Ultimate goal is to get the pre-approval letter on this first call. You'll want to make a formal application, understand what they're going to need, and provide it to them as soon as possible. Get the rates from them so that you can do your deal analysis. So find out what you should be plugging into your spreadsheet. It may not be the rate you get for your house, but do the stuff for the analysis. You're not calling them every day. What to plug in your deal, and what your monthly payment will be if you're buying an owner-occupant. Know your comfortable payment number and the max you qualify for. We already talked about why. Now we're talking about pre-approval. Get one before you look at properties. Have them send a copy to me. When we make an offer, we're going to get them to do an exact price. Some lenders we work with will allow us. They'll say, hey, listen, their max is 500. If it's less than that, feel free to modify the letter and send it over on our behalf. He's good up to 500. And they know me well enough, they're willing to have me do that. And then I always send them a copy so that they know what's going out and the price that's on it. Okay? And you include it when basically we make the offer via DocuSign. So that was pre-showings. Now we're going to do writing offer. So what you're going to need in order to write the offer is that pre-approval with the exact price or max you're qualified for. There are pros and cons to each. So in theory, you don't want to display your hand to say to a seller, especially if you're coming in a little bit under the market, which is not really a situation in this market, but sometimes you are. The property's listed for 300, you're trying to come in at 290. Better for your letter to say 290 than 500, right? Why are you coming in at 290 when you qualify for 500? It's not a big deal for you, right? But you really want to have it be that exact number in theory. Although it does demonstrate strength if you can do 500, right? They're more than qualified. You're not going to have any issues. We recommend exact price. So it gets included with your offer. So typically the first page when they pull up, when they see the offer, is your pre-qual letter showing you that you are qualified to do it. Or if you're paying cash, your bank statement or investment account statement or whatever it is. Then we go contract to close. So this is once you're under contract, you're getting approved for the loan. After initial underwriting, you receive a list of conditions for the loan approval. Brian's going to show you some crazy samples on the next slide. The list will be longer if you don't submit everything requested up front. Respond as quickly as possible. This is the point I was making, and what Brian says, get them their stuff so they can go to bat for you. So not only does this expedite your approval, it demonstrates to the lender that you are organized. Wouldn't you prefer to work with people who are organized and make your life easier? And this is me saying it. One of my clients believes this has caused lenders to go the extra mile.
Definitely my slide with people.
There you go. Modified by me. And then here are some crazy sample loan conditions. I'm going to let Brian do this because he has some really interesting ways of describing these.
Look at this slide. You're going to have to move. So, I mean, I had to, these were actual ones, right? Basically, provide 2013 K1s, which was from an investment in a, I think, private placement memorandum. So it didn't even relate, and it was not doing anything. Give an actual mortgage statement with a URL on the bottom for the account.
That's crazy.
Right? And so there, I'm like,
because I couldn't forge the URL.
right.
Because you're not going to be able to go log in and see the URL anyway. It's password protected. It's behind the login. But I'll just go ahead and generate one at the bottom of the thing if I'm a professional criminal.
December bank statement, which isn't anything out of the ordinary. LLC documentation, so provide the management agreement with the property manager for all currently managed properties. Like, why does my lender, when I'm about to buy a property, care about that? It doesn't make sense, but they do. Current leases for some of the properties. And if they're expiring and you're currently in the process of renting them, that could cause you some headaches. The HOA documents, man, this is like one of the biggest pains. Every property that has an HOA on it, they will need documentation of how much that is. And it's not okay that you just send them a little bill. All the HOA company sends me is a little bill, and it doesn't have my full name and the property address on it. It just has like the code for what it is. So they're like, no, it must have your full name, the amount of the bill, and your full property address.
So you just handwrite it in.
Yeah, like, HOA doesn't even send me this. So I had to call the HOA and get a signed letter from the HOA saying, yes, this is an accurate billing statement, which was silly. Sign a dated letter indicating you haven't given your social security number out, nor have association with unnamed person. Because they're like, this other person, like Carol Dwight, I don't even know what her name was, it's something like that. Shows up when we pull your social security number, and I'm like, I don't even know who that person is. I tried to track him down, but nothing, right? And then sign and return a bunch of documents. So tax statements for all your properties, blah, blah, blah.
All right, cool. Thank you. All right, so now we're on post-closing. So what happens afterward? So refinancing tips, rate and term. Take the current loan, change the rate and or term. That's the rate term refinance. Loan to value is typically 80% for 1 unit, 75% for 2 to 4. New appraisal likely required. Some lenders will allow you to refinance the closing costs in, the appraisal, and the rate buy down to be rolled in, which is, and actually they allow you to borrow even a little bit more and get a certain small amount of cash out. Brian, do you want to comment on that? When you do the, yes, you do. This is one of your favorite things in the world. When you do your refinance, they'll sometimes allow you to pull a little bit of extra cash out.
Yeah, so you can pull up to, I don't know what the exact number is, about $2,000, even if you're just doing a rate and term refinance.
Yeah.
Not doing a cash out. So have your lender adjust the numbers so that you actually get the extra $2,000.
Yeah. You don't have to come to closing and put in $500. You can have them over borrow and give you some extra cash back out.
Because typically on a rate term, they're just trying to get it close, right? They're not trying to make it exact where it's 0 owed. And so sometimes it turns out, I did a bunch of refis a year plus ago, all at the same time. And some of them were like, I got $2,000, and some I needed to pay $1,000. And she's like, I'm just trying to balance it overall. Had I known, I would have been like, oh, actually just give me
$2K for everyone.
all of them, or more, whatever you can.
Yeah. All right, cool. So new loan includes old loan plus cash that you were paid at closing. That's due to cash out. Loan to value is typically 75% or 70%. New appraisal is required. Typically used for buy, fix up, and hold. So those of you that are doing that model where you're buying a property, doing fix up on it, and then refinancing out, that's typically what we're doing here. The goal is to get all the money you put into the property back for use on the next one. That's the thought process in theory. It's hard to do right here. Some lenders require seasoning of the property up to 12 months. That is not a universal rule. So certain lenders, they definitely hold true to that. There's been some exceptions. And then refinancing as owner-occupant may, I want to say usually require you to live there for another year. So that would think was your question. Yeah, because they're going to have you sign another thing. And then the final slide here is something that I'm not going to go into detail. I managed to finish early. Kind of crazy stuff. So this is a slide from a client. Actually, it's not technically a client because he doesn't live in my area, but he was a client when he was here. But he basically had a lender go and prepare this for him. So some lenders will be able to show you like these little spreadsheets that show you different loan scenarios and what all the different stuff would be. So this one shows you, if you get a VA loan or if you do a conventional single-family home or you buy a duplex, do it in 2 different ways, what your down payment is, what your monthly payment is, what your PMI, and they can kind of run these scenarios for you. One of the lenders in town that does a really good job at this is it Fairway or My Fairway? It's Fairway, right? Yeah, Fairway, they must subscribe to a software service where they can do some really cool stuff with that, but it's highly unusual to have lenders be able to do this. But when they can, it makes it nice to be able to compare different loan options and see. And sometimes it's not intuitive. Like these charts that we gave you, wherever that is, these charts, this was not intuitive to me. And I see this stuff all the time. Some of these numbers on here, I'm like, wow, I'm surprised that they're that close or that they're the same or one beat out another one. This was a little bit surprising to me. So it is not always intuitive, at least not to me, and I see this stuff all the time. All right, any questions on, I guess there's no Q&A slide. Any questions on financing? Did we cover all the stuff you intended to get covered? No? It was a little overwhelming because I went too fast? I was afraid I wasn't going to finish in time. Was this new thing helpful, or should next time I do it, should I not provide a handout? Is the handout useful? Okay. All right, cool. If you have no further questions, thank you all for coming. Stick around for the class after the class, and Allison's going to be moving tables around because they were in a square when we came in. So you're welcome to do networking. We're not trying to kick you out, but we are trying to put the tables back because I am starving and I want to go eat dinner.
What's the class after the class?
Just networking with other people. Yep, thanks, guys.
Sure.